Speaker, I will be splitting my time with the Honourable the Leader of the Opposition. The government says it wants to avoid unintended consequences with its proposed tax changes. Here's one. What if these proposals simultaneously raise taxes and reduce government revenue? Let's consider the government's new tax on so-called passive income. Under the present system, when all is said and done, small business earnings are taxed at the same rate as wages. The only difference is timing. Assuming a 50% personal income tax rate, a wage earner pays 50 cents on the dollar in the year it was earned. A business, by contrast, will pay 15 cents in the year it is earned, and the remaining 35 cents when she takes the money out of the company. The government claims that this is allowing the business owner to invest that 35 cents inside her company and grow a bigger nest egg than she would if she had paid all the tax up front. This, according to the finance minister, is unfair. To prove it, the finance minister's so-called consultation document has a table showing how much better off this small businesswoman is by investing the after-tax proceeds of $100,000 of business earnings versus investing the after-tax proceeds of $100,000 in wages. In the first instance, the business owner has a starting capital of $85,000, with the small business tax rate being roughly 15% in most provinces. As an employee, she would have only $50,000 as starting capital. The result is that if both her and her employee had the same money and invested it in the after-tax proceeds, she as a small business owner would have $62,000 at the end of a 10-year investment, and the employee would have about $58,000, using round numbers that the government provides in Table 7 of its consultation paper. $62,000 at the end of the day, at the end of the 10-year period for the small businesswoman, and $58,000 for the employee. Not fair, right? But wait, there's one key detail that the Finance Department excluded from this table. In fact, the only detail that matters was excluded, and that is who actually paid more tax, the small businesswoman or the employee, after the 10-year period, assuming a 3% rate of return, as the department's table does. The government omitted that calculation altogether. They didn't want people to know who paid more taxes at the end of the day.
If they know, it's going to be
So I had a respected tax modeling firm headed by Jay Goodis, the chartered professional accountant and CEO of Tax Templates, do the math that the government left out of the consultation paper. So let's break it down. It is true that the employee paid more tax up front, $50,367 to be exact. He then paid another $8,023 on the interest earned in the subsequent 10 years for a total tax bill of $58,390. The businesswoman, on the other hand, paid admittedly less money up front, $14,400. Then she paid another $5,412 on her interest. So far, it's true, the business person has paid a little bit less. However, at the end of the 10-year period of investment, when she takes the money out, she actually pays a whopping $45,238. Because that money, that tax was not avoided, it was merely deferred. So she paid a total of $65,050, or about $6,700 more than the employee.
That's not fair.
Now, how is it possible that the small business person actually paid more tax and had more money at the end of the 10-year cycle? The answer is that the money on the deferred tax grew to a larger total. So when she pulled it out, there was more money to tax. In other words, both the business owner and the government are actually better off. This again under the scenario that the government put in its consultation paper, lest my friends across the way try to accuse me of contriving the right circumstance to get the right result. Now, to be fair, we need to take account of inflation. The business owner did pay the $35,000 in tax at the end of the 10 years as opposed to the beginning, during which time the value of money declined. The Bank of Canada has a target rate of inflation of 2%, which reduces the value of that $35,000 by $6,403. But still, even if you subtract that $6,403, the small businesswoman paid $250 more in tax than did the employee in this scenario. Now, Mr. Speaker, that scenario, of course, was perfectly contrived by the government to produce the best possible result to make its case. Now I'm using it to make mine. But if that business person and that employee had earned, say, 6%, still a very reasonable return, then the businesswoman would have paid almost $8,000 more tax, even after inflation is factored in, than the employee in the exact same circumstance. Also, the calculation is extremely conservative. I'm here excluding the benefits of having the entrepreneur invest the money up front and pay the taxes later. For example, the companies that she is lending to or investing in are paying her 3% for a reason. They're using her capital to hire people and buy profit-generating assets, which also generate tax revenue for the government. I'm excluding all of that revenue from my calculation. Now, the finance minister suggests that these types of passive investments inside a company constitute dead money.
Shame.
Now, he's dead wrong. In fact, this bizarre claim contradicts his own consultation paper, which calculated these very investments generate every year $27 billion in income. The only way these investments could possibly generate these returns is if the companies receiving the investments use them to fund their own growth. How much of that growth would be lost altogether if the government deletes the initial investment by forcing the business owner to pay that extra 35% up front on the principal, or a new double tax of 73% on the resulting income? Mr. Speaker, $27 billion in growth is a lot of money, and it can't be the result of dead money, because we know dead things don't grow. Now, the calculation that I put forward also excludes other behavioral responses that would inevitably result from the government's proposed tax increase. With the punitive 73% tax rates the government is threatening to impose on passive income, how many of these investments that I just described will simply not happen in the first place? How many young people will look at the diminished reward and simply say, why bother taking the risk? Or why not invest in another country other than the one in which he or she is born? Even if none of these behavioral changes happen, even if you believe the contrived scenarios the finance minister has developed to make his case, the government is still getting less lifetime revenue, according to Jay Goodis at Tax Templates and the calculations that he has provided. Now, when I asked finance officials these questions, they said, yes, it's true, we'll get less revenue, but it will be more fair because it will be more neutral. Mr. Speaker, that is the kind of negative, adverse thinking that this government has towards our entrepreneurs. This is not a policy of wealth distribution. It is a policy of wealth destruction.
Hear, hear.
The reason the government wants a policy that will reduce its revenue is because it will increase the revenue in the very short term as money floods out and into the coffers, because this Prime Minister wants to spend the money now, and so he wants to tax it now.
Correct.
Our view is that he should consult more, fix these problems, scrap this tax increase, and focus on growing the wealth of the nation so that the rising tide will lift all ships.
Yeah.